What if I told you Trump's return to the White House could put an extra $1,740 in your pocket or cost you $1,700 more per year? The difference depends on which policies actually become law. In this video, we'll break down exactly how Trump's presidency could affect your wallet. We'll answer 3 critical questions. What tax changes could save or cost you money? How will his policies impact inflation and your buying power? What should you do with your investments right now? But first, let's look at why the markets jumped to record highs after Trump's win, and what that really means for your money. Have you noticed how the Dow shot past 44,000 for the first time after Trump's win? Here's what's really driving this rally and why it might not tell the whole story. Wall Street is pricing in 3 big expectations: deregulation, lower taxes, and potential business growth. Historical data shows market performance is often more influenced by economic cycles than presidential policies. The initial market surge also reflects expectations of continued Fed rate cuts, though this might change based on policy implementation. Sectors like defense, energy, and banking are showing particularly strong gains due to anticipated deregulation. The S&P 500 jumped 2.2% in just one day after the election. But here's the key insight many are missing. This market pop isn't necessarily an affirmation of all things Trump. It's more about the market's relief that we have a clear winner. Think your tax bill is high now? Trump's proposing some of the biggest tax changes since 1940. The core of his plan? Extending the Tax Cuts and Jobs Act that's set to expire in 2025. These tax cuts would represent the 6th largest reduction in American history since 1940. State and local tax or SALT deduction caps might remain at $10,000, affecting residents in high-tax states. The corporate tax reduction to 15% could lead to increased business investment and potential job growth. Let's put this in real dollars. If you're a middle-class family making $80,000 a year, you could see your taxes drop by about $1,740 in 2026. But here's the surprising part. High-income households making over $14 million could see a massive $376,910 reduction. He's also floating the idea of eliminating taxes on Social Security benefits, tips, and overtime pay. Remember the inflation nightmare we've been living through? Trump claims he'll bring prices down very quickly, but economists are waving red flags. Here's why. His proposed 10% tariff on all imports and 60% on Chinese goods could actually drive prices higher. The proposed tariffs could particularly impact consumer electronics, clothing, and household goods from China. Supply chain disruptions from new trade policies might cause temporary price spikes in certain sectors. Small businesses might face higher operational costs, potentially passing these increases to consumers. Let's do the math. A typical middle-class household could face an extra $1,700 per year in costs due to these tariffs. Plus, experts predict his policies could push inflation up by an additional percentage point to 3.4%, well above the Fed's 2% target. Here's something interesting about Trump's growth plans. Oxford Economics predicts we could see GDP growth jump 0.3 percentage points higher in 2026. Initial corporate optimism could drive business investment in the first 2 years. Labor market changes from immigration policies might create wage pressure in certain industries. State-level economic impacts could vary significantly based on their trade and immigration dependencies. But there's a twist by 2028 that growth could actually drop 0.6 percentage points lower due to deportation policies and higher tariffs. Thinking about buying a home? Trump's policies could make an already tough housing market even more challenging. His mass deportation proposal could shrink the construction workforce, potentially reducing new home building when we desperately need more housing. First-time home buyers might face additional challenges in an already competitive market. Construction delays could increase due to labor shortages and higher material costs. Regional housing markets near the southern border might see more significant impacts. Those tariffs we talked about, they could drive up building costs, making new homes even more expensive. With potential inflation concerns, mortgage rates might not come down as much as hoped. Here's where things get interesting for your 4 o'clock K. Trump's proposed corporate tax cut from 21% to 15% could boost company profits. Plus, his lighter regulations on energy and financial sectors might lift those specific markets. Defense contractors and border security companies might see increased government contracts. Traditional energy companies could benefit from reduced environmental regulations. The banking sector might see reduced compliance costs and increased profitability. Bond markets might react to changes in government spending and deficit projections. International investment flows could shift based on new trade agreements and tariffs. But here's the strategic play many are missing. Cryptocurrency could see a surge as Trump's pledge to make the US the crypto capital of the planet. Let me share some strategic moves you might not hear elsewhere. First, consider sector rotation in your portfolio. Energy, financials, and industrial stocks typically perform well under Republican administrations with deregulation policies. Consider setting up tax advantage accounts before any policy changes take effect. Look into opportunities in infrastructure companies that might benefit from government projects. Research potential impacts on international investments in your portfolio given new trade policies. Estate planning strategies might need revision under potential tax law changes. Municipal bonds could become more attractive depending on state and local tax policy changes. Consider taking advantage of any market volatility by dollar-cost averaging into broad market index funds. This helps you benefit from any market swings while maintaining a balanced portfolio. Also, think about maximizing your retirement contributions now before any potential tax law changes. If tax rates do go down, you'll have already locked in deductions at higher rates. The key to navigating Trump's economic policies isn't about making dramatic changes to your financial plan. It's about making smart, strategic adjustments while staying focused on your long-term goals. Remember, not all proposed policies will become law, and many require congressional approval. The best strategy is to stay informed and flexible, making targeted adjustments as policies actually become law rather than reacting to proposals. Regular portfolio rebalancing becomes even more crucial during policy transitions. Diversification across sectors and asset classes remains key to managing policy-related risks. Stay flexible with your investment strategy as policies are implemented gradually. Consider maintaining higher cash reserves during the transition period. Keep track of state-level policy changes that might offset or enhance federal changes. If you found this analysis helpful, hit that like button and subscribe for more actionable financial insights. Drop a comment below, sharing which potential policy change concerns you most. I'd love to hear your thoughts. And remember, while these are expert projections, always consult with a financial advisor for advice tailored to your situation. Thanks for watching, and I'll see you in the next video.